In this session we are going to consider the different ways in which a business can price its products or services. There are three main approaches to pricing: demand-based pricing, cost-based pricing and market-based pricing, and we will deal with each in turn throughout this video. We will also consider other influences and factors that need to be considered when making pricing decisions. Before we look at the different methods of determining a price for a product or service, let us think about why it is important to get the price right. In order for any business to make a profit, it needs to sell its products or services for more than it costs to make them. So you might say, well, why not just set the price really high and then you can be sure that you have covered all of your costs? The problem with that, of course, is that customers may not want to pay the high price you are charging, and therefore the number of products you sell will be low and your fixed costs may not be covered. So there is a balance to be had between the selling price and the volume sold, and therefore the subsequent profit being made. And as already touched on, there are a number of factors at play here that need to be considered when setting a suitable price for a given product or service. In order to be able to think about the best price for a product, we also need to think about what might influence the price, and there are a number of factors that need to be considered. Price sensitivity. Some products are more price sensitive than others, and some customers will be more price sensitive too. If a product is price sensitive, it means that the volume of products sold will vary dramatically as the price increases or decreases. Price perception. This refers to the way in which customers react to price changes. For example, some people perceive that a high price means that they are buying something a bit more exclusive or luxurious than a lower priced similar item, and they are therefore prepared to pay the higher price for the kudos associated with the product. Quality. This is linked with price perception. Some customers equate higher prices with better quality, and again will be prepared to pay a higher price in order to buy what they consider to be a higher quality product. Competitors. Clearly, any business needs to consider what their competitors are charging and decide whether they want to compete on price or compete based on other factors such as brand loyalty, quality and so on. In some industries, like the petrol industry, you can see that prices change almost en masse. As one company changes price, they all follow suit. Inflation. This will have an impact on the costs we are incurring, and therefore a business will need to decide if they want to pass the increased costs on to the customer by inflating their selling prices, or whether they would prefer to keep prices as they stand and take a hit to their profit. Newness. New products, particularly in the technical sector, can often command a higher price as customers are generally happy to pay a premium for being one of the first to adopt the new product. Incomes. Here we are talking about the income of the customer. In the case of the general public, as disposable income increases, people are happy to pay more for goods and services. We therefore often see prices rising when an economy is strong and falling when an economy is weak. Product range. If a product sells interrelated products, they will need to think about the pricing strategy across the range of products rather than item by item. Ethics. A business needs to think about whether they wish to take advantage of shortages in a product or service and increase their price given that demand will be high. This might of course have a negative impact on their reputation, so they need to weigh up the pros and cons of such a move before initiating any price change. Now that we have considered the various factors that might influence our pricing strategies, let's look at the different approaches we can take to pricing. The first approach we are going to consider is demand-based pricing. As the name suggests, the prices we set under this approach are based on the demand we expect, or have historically seen, for the product or service in question. It is assumed that there is a linear relationship between price and volume. As prices rise, sales volumes drop, and as prices drop, sales volumes rise. How the volume is affected depends on the price elasticity of the product or service. A product that is more price elastic will show a big change in sales volumes as prices change. Think of luxury holidays and designer clothes. whereas a product that is price inelastic will show a small change in sales volumes as prices change. These are usually basic or necessary products and services like milk, bread and petrol. We can calculate the price elasticity of a product or services using the formula PED, which stands for price elasticity of demand, equals the percentage change in demand divided by the percentage change in selling price. A PED of greater than 1 means that a product is price elastic, and a PED of less than 1 means the product is price inelastic. If the PED is exactly 1, this means that the change in demand is equal and opposite to the change in selling price, and the overall revenue generated through sales is the same. We can look at a quick example to demonstrate this calculation. The price of a loaf of bread increases from $1 to $1.20, and the supermarket goes from selling 1,000 loaves per day to 900 loaves per day. We want to know what the price elasticity of demand is for the loaf. To calculate the price elasticity, we first of all need to calculate the two components within the calculation. So the percentage change in demand can be calculated as 100 loaves divided by 1,000 loaves, the 100 loaves being the drop in sales from 1,000 loaves to 900. This gives us a 10% change in demand. And the percentage change in selling price is calculated as 20 cents, that is $1.20 minus $1, divided by the original price of $1, giving us 20%. The PED is therefore 10% divided by 20%, so 0.5. This is less than 1, showing that the price is inelastic, as would be expected for a basic item like a loaf of bread. The price elasticity of a particular product may well change over time as demand for the product changes, and there are a number of factors that could affect the demand and therefore the price elasticity. The price of other products that could be used as substitutes for the product in question. If substitute prices are lower than the price of the product we are trying to sell, then in all likelihood demand for our product will drop. As already discussed, customer income will have a direct impact on the demand for certain product types. Tastes and fashions change, and therefore demand for products will also change as fashions move on. As technological changes are seen, some products will become obsolete, and as a result there will be a drop in demand for an item that may have seen steady demand in the past. In order to estimate demand for a product, we can use another formula called the demand equation, which states that P equals A minus B multiplied by Q, where P is the price of a product, A is the price where demand is 0, B is the demand line calculated as change in price divided by change in quantity, and Q is the quantity sold. BQ will always be deducted from A because the idea is that the quantity sold will increase as prices drop and vice versa. If we look at this in graphical form, we can see the demand line showing an increase in quantity sold as the price drops. Using the demand line formula together with some more information, we can take this one step further to find the optimal price for a product. The first thing we need to do is calculate the demand line as seen on the previous slide. We then need to find the number of units we need to sell to maximise profit, and this is the point at which the marginal revenue, that is the extra revenue generated by selling one extra unit, equals the marginal cost, the extra cost incurred in making one more unit. We can find the marginal revenue, MR, by adapting the demand equation. It now becomes MR equals A minus 2BQ. Once we know what MR is, we will also know what marginal cost is, or MC, as they equal each other at the optimum point. As we already know A and B from the demand line calculation, and we now know what MR is, we can then find the quantity to sell at the optimum point, and then substitute this back into the demand equation to find P, the optimum price. Let's put some numbers to this to make it a bit clearer. A company charges $12 for a product and they sell 16,000 units at this price. If they change the price by $1 per unit, the sales volume changes by 2,500 units. The product has a variable cost of $5 per unit. From this information, we want to calculate the optimum selling price for the product. So step 1 is to use the demand equation to find any figures we don't yet have. To find B, we take the change in price and divide it by the change in quantity. So this is $1 divided by 2,500 units in this case, giving us 0.0004. We also need to find A, and we can do this by inserting all the known figures into the demand equation and then finding A as the missing figure. We know that when P is $12, Q is 16,000 units, and we have also calculated B to be 0.0004. So rearranging the formula, we can find A to be $18.40. The next step is to make MR equal MC. The marginal cost of making one extra unit will just be the variable cost of making that unit, and we know from the data that this is $5. So if the marginal cost is $5, the marginal revenue will also be $5 at the optimum point. Knowing that MR is $5, we can now use the A and B figures previously calculated to find a figure for Q at the optimal point. Here we now use the formula MR equals A minus 2BQ. Therefore, $5 equals $18.40 minus 2 times 0.0004 times Q. Rearranging the formula takes us to 0.0008 times Q equals $13.40, and therefore Q equals 16,750 units at the optimum point. The final step is to put this quantity back into the demand equation to find P. So this time P equals $18.40 minus 0.0004 multiplied by 16,750 units, and therefore P, the optimal selling price, is $11.70. We can also find the optimal price using a tabular method. Again, the objective is to find the output level and selling price that maximise profit. The easiest way to understand the tabular approach is to demonstrate it with an example. In the left-hand column of the table, we are going to show different output levels, in this case 10, 20, 30, 40 and 50 units of output. We are then going to record the total cost of making that number of units. So in this case it costs $10 to make 10 units, $25 to make 20 units, $45 to make 30 units, $70 to make 40 units, and $100 to make 50 units. We can then work out the marginal or extra cost of making 10 more units at each output level. So to make 10 units from 0 units costs an extra $10. It costs an extra $15 to go from making 10 units to 20 units, an extra $20 to go from making 20 units to 30 units, an extra $25 to go from making 30 units to 40 units, and an extra $30 to go from making 40 units to 50. If we then look at the selling price at each output level, we can work out the total revenue we can generate at these output levels. $50 if we sell 10 units, $90 if we sell 20 units, $120 if we sell 30 units, $140 if we sell 40 units, and $150 if we sell 50 units. In the same way that we calculated the marginal cost, we can then calculate the marginal revenue at each output level. This will be an extra $50 when we sell 10 units, an extra $40 if we then sell 20 units, an extra $30 if we sell 30 units, an extra $20 if we sell 40 units, and an extra $10 if we sell 50 units. We can also find the profit we can generate at each output level by deducting the total cost from column 2 from the total revenue in column 5. At the output level of 10 units, we generate $40 of profit. At 20 units, $65. At 30 units, $75. At 40 units, $70. And at 50 units, $50. So we can immediately see that the optimum output level is 30 units, as this generates the maximum profit. You will also notice that up to 30 units the marginal cost is lower than the marginal revenue, hence the rising profits. Whereas after 30 units, the marginal cost is higher than the marginal revenue, and therefore the profits start to decline. There is of course one major flaw with this approach, and that is that we can only work with discrete amounts and cannot find a precise output volume to maximise profits. Now that we have looked at demand-based pricing, we are going to move on and consider cost-based pricing. Basing our selling prices only on our costs means that all external factors that we have covered for demand-based pricing are completely ignored, and the price is purely set by taking the cost of making the product and adding on a markup or margin to arrive at a selling price. There are three cost bases we can use to calculate a selling price. The total or full cost, that is all fixed and variable costs, production and non-production costs. The total production cost, this time this will be direct labour, direct materials and production overheads, both fixed and variable. Or the variable cost, being direct materials, direct labour and variable overheads. In order to ensure that we are still making a profit, we then add on an extra sum of money to cover fixed costs, if we are using the variable cost basis, to cover non-production costs if we are using the production cost basis, and in all cases to generate a profit. We call this cost plus pricing, the plus being the element that we are adding on. Like with demand-based pricing, we can model costs and revenues using equations. By knowing how costs and revenues relate to each other, we can then determine an optimal output and an optimal selling price, just as we did with demand-based pricing. The equation we are going to use this time is y equals a plus b times x, where y is the total cost of making x units, a is the fixed cost, b is the variable cost per unit, and x is the number of units being made. This equation does assume that fixed costs won't change as output levels increase, and that the variable cost per unit is the same regardless of changes in production volumes. In reality, the learning curve effect might result in the variable cost per unit reducing as output volumes increase, and at given output levels the fixed costs might step up to a higher figure, but this equation ignores these factors. For more information on the learning curve effect, please see the video covering this topic area. The variable cost per unit may also decrease if bulk buy discounts or volume discounts are being offered by suppliers. If this is the case, then the total cost, y, will need to be calculated at different volume levels to ensure that selling prices cover the appropriate costs. Once we have established the cost basis we are going to use, we then need to calculate the selling price by adding on a markup or margin percentage. Remember that markup is a gross profit percentage based on cost, whereas margin is a gross profit percentage based on selling price. There are many advantages to cost plus pricing. It is easy to calculate and understand. It ensures that all costs are covered and a profit is made. Junior management can make pricing decisions based on figures and percentages provided to them. On the other hand, there are disadvantages, the main one being that there is no consideration of all of the external factors that we discussed for demand-based pricing. Other disadvantages are: in order to find the full cost, we need to absorb the fixed overheads into the cost per unit, and therefore a basis for absorbing those costs needs to be established. Budgeted output volumes will also need to be established to perform the task of overhead absorption. And the pricing strategy doesn't guarantee a profit. If sales are lower than forecast, fixed costs may not be covered. We are now going to move on and consider different marketing-based pricing strategies. The first of these is market skimming pricing. This basically means that when a new product or service is launched, higher prices are charged to maximise profits in the short term. In later stages of the product's life cycle, the price will drop as more companies start selling the same or similar products and as customer demand starts to drop. The overall aim is therefore to generate as much profit as possible in the early stages of the product's life cycle to compensate for the lower profits that will be generated later in the cycle. This type of pricing is particularly suited to high-tech products like mobile phones and computers. The new technology encourages customers to purchase when the product is launched, and therefore a higher price can be charged while still maintaining a strong level of demand. Given the short life cycle of these types of products, it is also good to get as much cash as possible back into the business up front to cover the costs incurred in developing and launching the product. It is also a good strategy to follow if demand for a product is unknown. Prices can always be reduced if demand isn't as strong as was hoped, but it is much harder to increase prices if demand is very high at low prices. In order to keep prices high, there needs to be some barriers to entry for competitors, such as a patent on the product preventing anyone from copying the design, high levels of upfront investment, or unusually strong brand loyalty, as is currently seen with Apple. Rather than skimming the market with the pricing strategy just covered, we can also aim to penetrate the market by setting prices low to encourage high sales volumes. This is called penetration pricing. Typically, prices are set so that products are sold at a loss or minimal profit to encourage consumers to buy the product in large volumes. The idea being that customers become accustomed to buying that product and will then continue to buy the product even when the price is increased to a more profitable level. You can often see this in action in the supermarket when new foods are offered at knockdown prices on the ends of aisles to tempt us to try the new product. We also need to consider other products or services that complement the one that we are establishing a selling price for, to ensure that the price of all complementary products work together. We call this complementary-product pricing. So, for example, you might want to set the selling price for a particular printer fairly low, but the selling price for the cartridges that go with that printer fairly high. Once the customer has bought the printer, they will need to continue to replenish the cartridges for the printer, and therefore will be committed to buying the higher priced cartridges. A product line pricing strategy is needed where there are a number of similar products in the same range, and therefore prices need to be similar, if not the same, across the product range. The means by which the price is set could be demand-based or cost-based, with the same issues and factors needing assessment as covered earlier in the video. The prices that competitors charge may also be an influencing factor here. As already discussed from a purchasing perspective, volume discounts can be offered for bulk buying, whereby products are bought at a lower price when bought in higher volumes. The selling company need to think about how they would like their discounts to operate, or indeed if they are even going to offer them. Clearly, the main benefit of offering lower prices for higher purchase volumes is that the sales revenue will increase and cash flow should improve. New customers may well be keen to take up the offer too, so not only will you potentially generate higher sales volumes through your existing customer base, but you may also attract new customers that may continue to buy from you going forward. Volume discounts are also good if you are trying to sell off large volumes of surplus stock, or if a product line is coming to an end. The downside, though, is that profits will decrease as each unit is being sold at a lower price, with the same costs still being incurred in making or buying the stock for sale. It could be argued, though, that the reduced processing costs of processing fewer larger orders compensate for this loss in revenue and profit. A price discrimination strategy occurs when different prices are charged for the same product to different groups of buyers. This can only really happen if customers are split into different market segments, and customers can't buy at the low price and then sell on at a high price in a different market. A good example of this is train travel, where the same basic product, a journey from A to B, can be charged at varying prices, such as first class, peak and off-peak, for example. Finally, selling prices can be based on relevant costs, so we call this relevant cost pricing. This is often used when pricing up a one-off contract and when there is spare capacity within the business. The spare capacity indicates that fixed costs have already been covered by other products or contracts, and therefore only the incremental costs of this contract need to be considered when pricing it for the customer. The relevant cost of the contract is determined, and then a selling price is calculated based on this. The minimum price that should be charged is the total of the relevant costs, but more often than not a markup is added on to ensure some profit is generated by the contract. For more information on relevant costing, please see the video covering this topic.